All right, let's get right into it. When you think about the biggest risk to your portfolio, what pops into your head? A market crash, maybe? A recession? Well, what if I told you that the number one threat to your ability to create wealth isn't out there? It's right between your ears.
I mean, this quote just nails it, doesn't it? We are drowning in information. We've got charts, data, 24/7 news, and yet we can still make absolutely terrible decisions with our money. So why is that? It's because our brains, as amazing as they are, come with some serious glitches when it comes to investing.
And those glitches? Well, that's the hidden enemy we're talking about today, cognitive biases. You can think of them as mental shortcuts. They're hardwired into our brains to help us survive. You know, our ancestor hears a rustle in the grass. He doesn't pull out a spreadsheet. He just assumes it's a tiger and runs. Great for not getting eaten, absolutely terrible for navigating the stock market.
Now here's the really tricky part. You can't just decide to turn these biases off. It doesn't work that way. They're baked into our DNA. And the single biggest mistake anyone can make, and I mean anyone, from a total beginner to a Wall Street pro, is to think, oh, this doesn't apply to me. Trust me, it does. The game isn't about eliminating them, it's about managing them.
So enough with the theory. Let's make this real. We're going to walk through 4 of the most dangerous mental traps that investors fall into time and time again, and we'll see the kind of real-world damage they can do to your wealth.
First up, meet confirmation bias. This is basically your brain's love for being right. It loves to build a little echo chamber for itself. So once you decide, hey, I really like this stock, your brain subconsciously starts hunting for every article, every opinion, every tweet that confirms you're a genius, while conveniently ignoring all the red flags screaming that you might be wrong.
And the cost of living in that echo chamber can be staggering. Just look at the Yes Bank situation between 2018 and 2020. Investors were absolutely in love with its past growth. It was a superstar stock. But at the same time, there were more and more reports coming out about bad loans, about major issues with management. To a lot of people, though, that was just noise. They filtered it out, right up until the stock plunged 95%. Ouch.
Okay, next up we have anchoring bias. This one is all about your brain getting stuck on a number, usually the first number it sees. It could be the price you paid for a stock, or maybe its all-time high. And once that number is lodged in your mind, it acts like an anchor, right? It holds all of your future decisions hostage to that one, often totally irrelevant, reference point.
And this bias isn't just about losing money. It's about the opportunities you miss. Take Reliance back in 2008. It hit this huge peak price that got seared into investors' minds. Years later, when the stock was trading way down at 800 rupees, a lot of people just thought, well, it's still so far from its old high. They waited, and they missed a 3x return, because their brain was anchored to a number from the past.
Our third trap is a deeply human one, herding behavior. We're social creatures. We're wired to feel safe in a crowd, and we have a deep, deep fear of being left out. In investing, this translates into pure FOMO, the fear of missing out. You end up buying something not because your research says it's a good idea, but because it feels like everyone else is doing it and getting rich.
And we all have a front row seat for a perfect example of this, the crypto and NFT mania of 2021. It was electric. It felt like everyone you knew was suddenly a crypto millionaire. The herd was stampeding. People who had never invested before were piling in, buying assets at insane prices just to be part of the action. And, well, you know how that story ended. When the bubble burst, the vast majority of those who followed the herd off the cliff lost 70, 80, even 90% of their money.
And that brings us to our fourth and final trap. And it might be the most seductive one of all, overconfidence bias. This one thrives in a bull market, when everything is going up and it feels like you can't miss. It's so easy to confuse luck with skill and start to believe you're some kind of investing prodigy. And what happens when you think you're a genius? You start taking bigger and bigger risks.
And the numbers on this are just sobering. Think about the market run-up in 2020 and 2021. A whole army of new day traders jumped into the game. For a while, making money was easy and they felt invincible. But when the music stopped and the market turned, a staggering 90% of them lost money. Their can't-lose strategy suddenly stopped working. That's what happens when overconfidence smacks into reality.
Okay, I know that was a lot of bad news. These biases are no joke. They're powerful and they're costly. But here's the good news. You are not helpless. You can build a system. Think of it like a mental shield to protect your portfolio from the biggest threat it faces, your own brain.
So what do the pros do? They don't just rely on willpower. They rely on a process. It usually has a few key parts. First, a pre-decision audit. Before they pull the trigger, they literally stop and ask, okay, which of these biases could be messing with me right now? Then, they actively play devil's advocate. They try to prove their own great idea is actually a terrible one. Third, they keep a decision journal to track why they made a choice so they can't fool themselves later. And finally, they get an outside opinion from someone who can be objective.
Now that might sound complicated, like something only a hedge fund manager has time for, but it's not. You can start building your own simplified version of this shield right now, today. The key is to turn these ideas into simple actions.
So here's a simple starter kit for you. First, make a quick checklist of these 4 biases. Just look at it for 10 seconds before you buy or sell anything. Second, start a decision journal. It can be a simple note on your phone. Just write the date, the decision, and 1 sentence about why. Third, try the pre-mortem technique. This one's amazing. Before you invest, imagine it's a year from now and it's failed spectacularly. Write down the story of how it went wrong. And finally, find an accountability partner, a friend who you can trust to challenge you and ask, are you sure about that?
And I have to leave you with one final, absolutely crucial warning. It's called the paradox of bias awareness. And it goes like this. Just by learning about all these biases, you can start to feel overconfident, thinking, great, I know about these things now, so they can't affect me. That is a trap. Awareness is not the cure.
Remember this, the cure is action. The cure is having a process. Awareness is just the first step. It's the starting line. So the real question I want to leave you with is this. What will your second step be? What system, what simple habit will you put in place to start protecting yourself from yourself?